Yeah, thanks again for having us. We kind of looked at this as a good opportunity for us to kind of introduce ourselves to you guys, in addition to cover a topic that hopefully is of interest to some of you guys. Like Tommy mentioned, we're new sponsors, and we want to kind of let you guys know that we're here to be a resource to you. So if you kind of see us around and have questions, like please feel free to let us know, and we'll figure out a way to help you out. Um, you can go on to the next one if you want to. Before we get started, I've always got a couple of housekeeping items that the firms and the attorneys always kind of try to make us do. My favorite one is this disclosure that I've got to do first, and that's that despite what we do for a living, nothing you hear today is really intended to be tax advice. I realize that, like I said, it cuts our credibility right in half from the very beginning, but the reason for that is just that everybody's tax situation is different. So we're kind of painting with a little bit of a broad brush here, but hopefully this will kind of help some understanding. Also, taxes are inherently political. So there are some of the things I've got to talk about, and I'm going to go over a little bit of Biden's tax plan that's at least kind of the rumored proposals. If you hear something I say and you think, is he trying to make a political point? Let me go ahead and tell you I'm not. But I'm always kind of trying to start off with that because I know that there's some of this that could be kind of misconstrued. But before we kind of start talking about employee retention credits, which Ryan's going to go over in some detail, I thought it might be helpful to look back at kind of how we got here and where all this money is coming from and what its intended uses were. So there were actually really 5 major pieces of legislation that included some type of COVID relief that was meant to get kind of down to your average worker. And I found this graphic and I thought it was kind of interesting, but that shows you how much we've spent. I mean, it's over $4 trillion and counting in terms of what they've allocated and what's actually been spent. There's still a big gap there, but the reason for, you can move on to the next one. The reason for splitting this into several different programs was when you think back to right when COVID hit, there was the PPP program, there was stimulus payments, there was that expanded unemployment compensation. And part of the reason for that was when you're trying to get money into pockets quickly, you can't overwhelm one department. So with the PPP program, you had the SBA administering that. With both the stimulus payments and the employee retention credits, you've got the IRS handling that, and then you've got the unemployment offices handling that employment piece. So some of this was really to take pressure off of unemployment offices. I don't know if any of you are dealing with this right now, but in Texas we're starting to see a problem where there are people that are claiming unemployment on behalf of, using your Social Security number. We've had that in our office. Our HR people have called a couple of my colleagues to let them know, hey, somebody's out there claiming you're unemployed. But there are just all sorts of issues like that kind of pop up whenever you rely on one department too much. And so when you think about how much money we spent and how quickly they got it out, they really did a pretty good job. But it also kind of helps you understand why there were so many hiccups and changes to the Paycheck Protection Program, and why they had to change kind of how these credits work, and the Consolidated Appropriations Act as well. So, before we kind of get into the framework that Ryan's going to take care of, there are a whole lot of rules and it's kind of granular. So at the end of his presentation, there are a couple of decision trees that will kind of help determine pretty quickly whether or not these credits might be available for you or one of your clients, or a business owner that may be able to benefit. If you guys want a copy of those, just let us know, and we can shoot you an email. But that's been the best resource that I've had specific to the ERC. So I want to let you guys know about that, and Ryan will kind of start with the details of the program.
Okay, I'm going to talk about the employee retention tax credit. It's eligible for qualified wages to both companies that have used the PPP loan and still had wages that exceeded the loan amount. An eligible employer is either they were shut down due to the government or court orders by the city or local authorities. And this is for 2020. And their gross receipts were more than 50% less than the same quarter in 2019, and up to 80% in the same quarter of 19. Oh, sorry. This is for 2020. Oh, sorry. Right. There is a difference between 2020 and 2021. Right. Wait, the wages paid out. Go back to the 2020 here. Oh, sorry. Gross receipts includes total sales and income from services provided. It also includes interest, dividends, rents, royalties, and sale of assets, and does not include cost of goods sales. Cost of goods sold. This is for 2020. An eligible employer for 2020 example, let's say it's for quarter one. You had 100,000 in quarter one of 2019, and quarter one of 2020 was 40,000. So 50% of the 2019 would have been 50 grand, and 80% of the 2019 would have been 80 grand. So that therefore the 2020 first quarter would qualify because the income was less than 50% of the 2019 gross receipts. And this will continue until the 80% of the 2019 gross receipts is met. I'm going to show you an example of what would not qualify. So there's quarter four of 2019 was 100,000. Quarter four of 2020 was 125. 50% of the 2019 was 50. 80% of the 2019 was 80. So because of the receipts were 125,000, there was ERC would not qualify. Well, if those wages have got to exceed the PPP loan amount, so. As long as your gross receipts, No. The amount that you can qualify has to exceed the PPP loan that you've used. You can't do both, but if you've got wages in excess of the 300,000 PPP loan, you can use some of that up to 10,000. This is for 2020, up to 10,000 per employee, and then. Right. And your receipt, and your receipts were, right. Okay, and then there's different, if your business started in 2020 and you didn't have business in 19, there's different criteria, different things to look at when you're factoring in the eligibility and everything. Okay, in 2021, the threshold goes from 50 to 80, or let's say goes from 50 to 20. So as long as your revenue is more than 20%, the reduction, then you for quarter 20 or any quarter in 2021, you're going to qualify, or your business got suspended. Now, as far as qualified wages, the wages, if you've got a relative or individual of the company, the ERC cannot be taken on those wages because it's a related individual. And the qualified wages for 2020, you have to have 100 or fewer full-time employees and can only count for people not working. So if you've got somebody that's not working that you're still paying. Right. Okay, and then for 2021, that 100 full-time employees goes to 500 or fewer employees. So there's difference between 2020 and 2021, and for wage limitation on the 2020 credit is equal to 50% of qualified wages. Max wage is $10,000 per employee for the entire year. Wages include healthcare costs, even if the employer didn't pay actual wages. So if you're paying for healthcare for someone, those wages can be construed as qualified wages. Okay, for 2021, the credit is equal to 70% of qualified wages, not 50 like in 2020. Max amount of wages is $10,000 per employee per quarter versus $10,000 per employee for the year in 2020. And again, wages include healthcare costs in 2021 as well. 2021, 70% of the wages paid to employees from January through June 30th. Wages are limited to $10,000 per quarter, max credit of $7,000 per quarter, and it can exceed the amount the employer was previously paying the employee. Okay, and then there's a flow chart or a tree chart at the back. Here we go. In 2020, was business fully or partially suspended due to government order during any quarter of 2020? Yes. Were wages and or health insurance premiums paid for any employees during period of business suspension? Yes. And then you got to factor in the 100 full-time employees, and if there's greater than 100 were employees paid not to work, and if so, some of the credit is available but is subject to overlap rules or PPP forgiveness. And no, during qualified period where health insurance premiums paid for employees, furloughed employees, no, employee retention credit isn't available. Let's say for 2020, 2021, was business fully or partially suspended due to governmental authority during first 2 quarters of 2021? Yes. Were wages and our health insurance paid for the employees during the business suspension? Yes. Greater than 500, again, you may be limited due to overlap rules with the PPP forgiveness. No. You've got to reach the, where gross receipts in either of the first 2 quarters of 2021 less than 80% of the same quarter of 2019. Yes. Were the average full-time employees greater than 500? Yes. During qualifying period where employees paid to not work, some employee amount of employee retention credit is available, but is subject to overlap rules and PPP forgiveness. So again, you just have to look at 2020 and 2021 to factor in the qualified wages and the ERC credit. Okay. Thank you.
Cool. So one other, we've got a couple other quick topics here, but one of them being qualified small business stock. I figured that might be topical just because that is one part of the tax code that is specifically intended to encourage entrepreneurial activity. Basically, what qualified small business stock is it's stock that you could wind up excluding 100% of the gain from your tax return whenever you sell that stock. So if you start a business, you put it in the right entity format, like it's a C corporation. It's got to be an original issuance. So you've got to be basically one of the first owners of that stock. You can see your business appreciate. You go and you sell it to somebody. As long as you sell the stock, you don't have to pay any tax on that transaction up to $10 million, which is a great exclusion. And if you're wondering, like, hey, why haven't I heard about how to sell my business and not pay tax? It's because there's kind of some limitations. You can go to the next slide, Ryan. There's kind of some limitations on how feasible it is to really pull this off. A lot of that is based around. Oftentimes, your buyer is going to want to purchase your assets and not your stock. And right now, in particular, the tax advantage for the buyer and the impact it has on the seller are not really, they're not far apart enough to encourage somebody to go the 1202 route and try to get their stock qualified as qualified small business stock, because the buyer is getting such a benefit from depreciation deductions and some other kind of related tax benefits. They basically get to amortize goodwill, step up the basis on all of your assets, and take that extra depreciation. So what's interesting about this is, as little as we see this now, with the Biden tax plan and kind of some of his proposals, we might get closer and closer to where if we get rid of the cap gain rate, for example, this might really push people toward this entity structure where your price between whether or not you're going to sell stock or assets, that could widen and get to a point where if I'm looking to acquire a business, I may be more open to buying your C Corp stock. I mean, assuming there are no legal issues, or liabilities that I'm trying to strip out of there, that may start to become more attractive. So as we hear more and more about Biden's plan, I think that if somebody is starting a company or looking to do something new, it's something we kind of need to take fresh eyes at, because while it's out there, very few people are actually able to use it. It might become more and more feasible to go that route, knowing that acquirers could look at them differently. And here's just kind of what we've heard from Biden's tax plan. We saw all the spending on the front end that has happened, and especially with this infrastructure bill, they're already kind of having to talk about revenue offsets. You can see, like, raising the top income tax rate, raising the corporate income tax rate from 21 to 28, eliminating like-kind exchanges, and then the real highlight has been what they've talked about around either eliminating capital gains or taxing capital gains and dividends at a much higher rate than we currently are used to. That's kind of what was driving the conversation around the qualified small business stock. If you take away any cap gain treatment from the other end of that, you're gonna have sellers look harder and harder at ways to try and avoid that tax, and it may be worthwhile for a buyer to forego some of the tax advantages on the back end. And then he's got another interesting proposal, basically targeted at like big companies like Amazon, that they have net operating losses every year because of depreciation or whatever else. They want to be able to tax them on their book income. So they're tired of seeing SEC filings showing, oh, you're making billions and billions of dollars, and then we don't really ever see any federal tax income revenue from that. But this is all, we're all still kind of speculating. There's not been like really an official tax bill kind of set up, but it's interesting to look at and kind of figure out how that might impact some of you guys, because it's getting to a point where I've got some clients calling and asking, should I try and accelerate income into this year? If I've got unrealized capital gains, like, does it make sense for me to take that cash off the table? You've kind of got to look at it a little bit backwards when you're expecting a higher tax rate environment than what we're in now. But I think with that, we'll wrap it. If you guys have any questions, let me know. Yep. So with you in particular, we'll look and make sure that there's eligibility and going back or going forward. The main thing you want to look at right now is see if the rules for 2021 and going forward are easier, and the credits are larger. So I'd first look at kind of one of those flow charts and see, and go through with your tax advisor kind of the same questions, and then the mechanism to claim the credits. Since it's a payroll tax credit, a lot of times you're gonna have to work with your payroll service provider if you have one, or if you do that internally, that would be a good time to reach out to a firm to help you out with that, because the mechanism is to go back and amend 941s in the past, or you can basically either short pay on your 941s, like stop making payroll tax deposits right now, or you can claim an advance refund. There's a form called 7200 that you can do that on, but it's definitely worth, if you look at that flow chart and you think that you fit into one of those categories where, yes, there is some credit available, I think you definitely want to reach out and kind of talk through. It's got to be on the 941s. So it also creates a funny issue where you're going to have amended 2020 reports, and then you'll have your W-3 is not going to match your tax return anymore because you actually paid less, like FICA and social, Medicare tax. Right. 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 Yeah, that advance is nice because you don't have to go back and amend the report first. You can do it now and get your money and then come back and match up. So in advance, it's got to be, I think that's got to be a look forward deal. So you've basically got the choice now, and it's a new form, so presumably it's got to be a 2021 deal. But you can either short pay that payroll tax deposit or ask for the advance. I believe only for the 2021. That's correct. In amended 941. Yep. Yep. And there's been some confusion on the going backward stuff. The mechanics on that. I mean, I think, for example, 3 days ago we got some more guidance from the IRS. So it's not this, much like the PPP program, is rolled out kind of slowly. Yeah, yeah. But no, yeah, I think the important thing is the go forward stuff, because that's the quickest way you're going to be able to get cash. Because the other thing is the IRS is so inundated with all of this stuff that they are so far behind on processing anything. If you paper filed a return last year, you may not see that one get processed, and you may not get your refund for another 6 months. I mean, that's part of the reason why they delayed the deadline, is trying to let them catch up a month. Yes, sir. So I've read a little bit about that, not enough to speak intelligently about it, but so much of what they're talking about right now is, it's not, I wouldn't even call it a proposal yet. I mean, this is all kind of conjecture until they actually start putting pen to paper. So really what they're trying to get rid of is the step up in basis. So if dad had a piece of property that, you know, he had somehow fully depreciated, I don't get to take it and have $100,000, you know, fair market value on that. Now, I suspect the way that they'll do that is that that's only for if you didn't pay the estate tax. If you paid the estate tax, presumably somebody paid for that step up in basis. If you don't, I think those are the ones that they're most worried about is, you know, did I inherit a bunch of Coca-Cola stock that has just been held by my parents forever, and they bought it at $2, and now it's at whatever it is. Yeah, they're wondering if I should be able to inherit that at current value or if I should have to have carryover if we didn't pay the estate tax. Well, and what's funny about estate tax is if you look at federal revenue, like pie chart, the estate tax is this sliver. So like they can have a bunch of political fighting about it, but like it's not a big revenue raiser. It doesn't move the needle, but yeah, and it's a political football for sure. It's easy to point and go wait, but it doesn't make really much of an impact either way. Cool. Well, if there are no other questions, we'll be over here if you have any others, and I appreciate you guys having us.
Thanks, guys. Appreciate it. All right, so yeah, Robert and Ryan will be here, so if you have any more questions that come to mind, and let you get back to finishing your lunch.